Now that we've understood Alder Capital's investment philosophy, if we can go one step deeper and understand that when an incoming client/investor comes to Alder Capital, how do you go about creating the portfolio? Do you follow a model portfolio theory, or is it creating individual portfolios, and why so?
We look at internally all our investments by way of comparative advantages and how we can actually revolve a portfolio around that. So there are many businesses which are brand oriented, right? There are businesses which have process scale advantages. There are businesses which have network effects. So right, so we need to actually build a comprehensive list of companies which fit into those buckets. Other managers would look at large, mid and small. They would look at it as sectoral classifications. Well, those are nice things to have because it makes you quickly understand how your portfolio is constructed. But for us, the core of our heart of the portfolio is basically what do these businesses bring on table, right? And how are they catering to the demand side of it? And what are the advantages? So when we do that, we have a benchmark portfolio internally, and when a new client comes in, the question of how we allocate depends on the market cycle. Give or take, if we were at a situation where we were in April 2020, where the markets had crashed, I probably would have deployed everything that came in that day, right? It's another thing that we all were skeptical at that particular point of time. In hindsight, we said, oh wow, it's a great level to be at. But the point is that when you look at stocks and when you run these analysis on a forward basis, you realize that many of these businesses could deliver a 25 to 30% returns at those levels, right? And if new money did come in at that time, which is rare, right? Many times retail investors do not want to deploy money when the markets are at the bottom most. And if it did, and in one case, a few cases, we did get money, we deployed everything immediately in a week's time. But there are times when the markets are at a peak, we have to peak in the sense that short-term peak, and we feel that there could be a cool off, which could be a 5% cool off. We deploy the money over a 1-2 month period. But at the end of the day, after one is deployed that capital, it will resemble a benchmark portfolio that we run internally, right? Our internal benchmark portfolio will be completely different from a BSE, right? BSE would have a lot of weightages in commodities and in export oriented business and in banking and financials, right? Which constitute a large part of the BSE weightage. So our internal portfolio is very different from that, but all our clients' portfolios resemble the internal portfolio after, give or take, after 1-2 months, right? So generally, there is no customized portfolio that we operate. It makes it easy for the clients because they wouldn't come back to us and say, hey, your benchmark is doing something else, but my portfolio is underperforming, or maybe the other way around. So at a given point of time, post that point, typically the entire aggregate portfolio of Alder Capital performs in sync with individual client portfolios.
What Sir just explained, for an incoming client/investor who is coming into Alder Capital, the portfolio will be structured using a benchmark portfolio, and the way Alder looks at the portfolio is they divide it into 4 different categories, which we of course will know more about as we ask more questions. But primarily the portfolio gets divided into production capabilities, brands, very high exit costs for consumers, and the 4th is networking effect.